The Genius Group Ltd. (GNS) stock price is currently trading at $0.8629, reflecting an intraday move that is hard to pin down with absolute certainty right now, due to the low float, high volatility nature of the stock, but it's hovering near a slight positive movement, continuing the choppy but overall upward trend seen over the last several months. The immediate headline that should shock any longtime watcher of this stock, and certainly goes against the general expectation for a small-cap education technology company, is the $250 million class action lawsuit GNS has just filed against two massive market makers, Citadel Securities and Virtue Financial, alleging a multi-year scheme of market manipulation through illegal spoofing and naked short selling. This immediately creates a huge tension between expectation and reality, because the typical narrative around GNS is one of a highly volatile microcap ed tech struggling with profitability and relying on aggressive shareholder engagement tactics. The reality is that the company is taking an unprecedented and extremely aggressive legal stance against some of the biggest players on Wall Street, turning their fight against alleged bad actors from an internal shareholder communication point into a serious formal legal challenge that seeks massive damages. This is a bold, almost defiant move that completely changes the context of any analysis of the stock's recent performance and its future outlook. The market's general belief about Genius Group is often a simplified and cynical one. It's a sub-$1 stock on the NYSEAMERICAN, associated with meme stock dynamics, high retail interest, significant volatility, and a business model that is a mashup of education, entrepreneurship, and a very public commitment to a Bitcoin treasury. The company's stock chart over the past year reflects this chaotic expectation. It has experienced wild swings from a 52-week low near $0.21 to highs near $1.92, which is a classic pattern of a heavily shorted stock experiencing intermittent short squeeze rallies driven by retail enthusiasm and company-specific catalysts designed to encourage book entry holding. The reality, however, is that GNS's core strategy is now inextricably tied to its legal battles and its attempts to tighten its share structure, which directly affects its trading behavior. The filing of this class action suit, which claims manipulation occurring on 98% of all trading days during a specific multi-year period, provides a potential legal justification for the very volatility and depressed price that retail investors have been complaining about. This legal action immediately elevates the discussion from a purely fundamental or technical one to a regulatory and structural one, which is a far deeper take than most are used to. Instead of just analyzing the stock price in a vacuum, we now must analyze the potential outcomes of a major federal lawsuit and what that means for liquidity and price discovery. Looking at the recent stock movement, the sheer volume tells a story of intense speculation and counteractivity. While the company's valuation remains modest, recent trading days have seen share volumes in the millions, far exceeding what one would expect for a company of this market size based purely on its education business. This high volume is the smoking gun that feeds the narrative of intense short versus long battles, and the company has been consistently fueling the long side with highly visible strategic maneuvers. For instance, the announcement of a $10 per share loyalty payment in Bitcoin to shareholders who transfer their shares to book entry via the Direct Registration System, DRS, by a November 28 record date is a powerful direct incentive designed to reduce the float, the number of shares readily available for trading, and critically, for short selling. This move, which they explicitly state is designed to reduce shares available to short sellers, coupled with the new lawsuit, paints a picture of a management team that is prioritizing the structural fight over their stock price as much as they are prioritizing the growth of their core business. This isn't just self-investing, this is a company using its corporate actions to fight alleged manipulation, which is a rare and remarkable position for any publicly traded entity, especially one of this scale. In an age where individual brokerage platforms like Robinhood, SoFi Invest, and Fidelity allow easy access to stocks, this kind of corporate action directly engages and weaponizes the retail investor base, often associated with phenomena seen in names like Tesla stock in the past. Drilling into the company's core business, which is easy to overlook amid the market noise, Genius Group Ltd is an education technology group focusing on an entrepreneurial ecosystem, primarily targeting entrepreneurs and students across various stages of life. They describe themselves as an AI-powered, Bitcoin-first education group, which is certainly a mouthful of buzzwords, but the core business is about providing online and in-person learning, micro-degrees, and a global marketplace, Genius U, that connects millions of users with knowledge and opportunities. They acquired a 51% stake in two Bali-based education projects for $7.1 million recently, which illustrates their geographic expansion strategy to create genius cities that blend education with entrepreneurial communities. They also brought on Rich Dad, Poor Dad author Robert Kiyosaki as a board advisor, a move clearly intended to add star power and legitimacy to their entrepreneurial focus. Their financial performance is a mix of pro forma growth from acquisitions and underlying losses. For the first half of 2025, they reported a 25% revenue growth to $6.1 million on a pro forma basis, which sounds good until you note that their review basis revenue declined by over 44%. The company attributes the net loss widening to $17.3 million, largely to legal costs and forced asset sales related to previous legal constraints, claiming $15.9 million of the loss is directly tied to these issues. This highlights the inherent contradiction. The growth narrative is there, particularly through acquisition and a stated goal to reach a $1 billion valuation by 2030 with 100 million students, but the financial reality of the existing business model and the weight of their ongoing litigation still results in significant negative profitability. The Bitcoin-first aspect is where the company steps far outside the traditional edtech box. They are actively accumulating a Bitcoin treasury, with a target to reach 1,000 Bitcoin to join a small club of public companies with such holdings. They see this Bitcoin treasury as a key driver of shareholder value, stating their belief that future digital economies will be run on digital assets. They also have a blockchain-based microlearning platform using student credits, called GEMs, which are linked to Satoshis. This is a fascinating, if highly speculative, overlay to their traditional education business. For an investor using a platform like Fidelity, Schwab Intelligent Portfolios, or Interactive Brokers, they are essentially buying into two very distinct and non-correlated assets, a microcap education company and a leveraged play on the future value of a Bitcoin treasury, all wrapped up in a high-stakes legal drama. This complexity is what makes GNS so compelling to a certain type of self-investing shareholder, but also what makes traditional institutional investors wary. Institutional activity in GNS is relatively small, which is typical for a microcap stock, but the data shows some interesting shifts. There are a small number of institutional owners, around 12 dozen, holding a total of a little over 1 million shares, which is a small fraction of the outstanding shares. While the raw numbers are low, the month-over-month change in reported institutional shares has been erratic, suggesting that institutional players are largely using GNS as a tactical trading vehicle rather than a long-term investment. This reinforces the overall picture of a stock dominated by short-selling forces and retail trading, with institutions mostly playing the short-term volatility rather than committing significant capital for the long haul. This low institutional ownership is a double-edged sword. It means there is no major long-term capital anchoring the price, making it susceptible to manipulation and wild swings. But it also means any significant institutional interest, should the legal and operational picture clear up, could act as a powerful buying catalyst. It's a prime example of the kind of stock where fundamental analysis must be balanced with market structure analysis, a skill essential for anyone trying to navigate the current climate of online investing. Looking ahead, the future of Genius Group stock is fundamentally tied to two major non-traditional catalysts. First and foremost is the outcome of the class action lawsuit. If the company is successful in its legal challenge, even a partial victory or a favorable settlement could provide a significant capital injection and, more importantly, potentially reduce the alleged manipulative pressure on the stock. A win would validate the company's long-held narrative and likely create a massive surge in retail sentiment and buying volume, potentially causing a dramatic short squeeze. However, litigation is notoriously slow, expensive, and uncertain. The other critical catalyst is the Bitcoin treasury and the share structure adjustments. The success of the Bitcoin loyalty payment program in moving shares into book entry, DRS, by the November 28th record date is a direct measure of management's ability to execute their strategy to lock up shares and reduce the shorting pool. The November 28th record date is a near-term event that will bring acute focus and likely short-term volatility as investors weigh the pro-rata Bitcoin bonus against the risk of holding a volatile stock. If they hit their target of 1,000 Bitcoin, it would turn the company into a legitimate, albeit a small, institutional player in the Bitcoin space, linking the stock's performance to the macro narrative of digital assets, much like MicroStrategy. The expectation is that GNS is just another low-price stock with an uncertain future. The reality, however, is that this stock is less a pure education company and more of a litigation-driven, crypto-backed